On May 12th, Ian Lyngen, Managing Director and Head of U.S. Rates Strategy, BMO Capital Markets, shared his thoughts on the outlook for the rates market at the 2026 BMO Real Assets Conference in New York. The Federal Reserve has a complicated path ahead amid growing uncertainty on inflation, growth, and the labor market. Let's listen in.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/marketsplus for more episodes.
I'm the head of U.S. Rate Strategy at BMO Capital Markets, and so my goal when I get up in the morning is to try and get a sense for the direction in which interest rates are going to go, what that means for other assets, and frankly, what that means for forward expectations for monetary policy, what that implies about the state of the macro world, and how to translate that all back to the Fed and back to a forecast for rates more broadly. I do want to make a couple observations early. First is I'm very cognizant that there is an argument in the market at the moment that the Fed's next move should be a rate hike, not a rate cut. I do think that reflects a lot of the uncertainties in the market, and I'll discuss those in a little bit, but I'm still operating under the assumption that by the end of the year, the Fed will have more clarity in terms of the fallout from the war in Iran and what it means for the inflation complex, for unemployment, and for the broader macro stage. And so we will be discussing rate cuts by the end of the year. As a result, I'm reasonably constructive on the front end of the market. I have 2-year yields ending this year at 3.5%. I have 10-year yields ending the year at 385. Now, we're currently at roughly 440 in 10-year yields. So if we look back historically, a rally of this magnitude, 45, 50 basis points, really nothing dramatic. And I think that that's one of the key messages that I would like you to take away from this morning. And that is the Treasury bond market came out of 2025 having survived some of the key bond bearish risks. The first was the trade war that started. There was going to be runaway inflation and no one would ever touch a Treasury bond again. There were expectations for 10-year yields to be at 550, 575 as inflation came through the system. But what we've seen is that tariff-related inflation has led to certain pockets of sticky prices on the consumer side, but by and large, the bulk of this has been absorbed either through profit compression or delayed pass-through of tariffs to the end user. The problem that this has created for the Fed, and they continue to struggle with this, is that they're not yet convinced that we have worked all the way through some of those sticky pockets of inflation. Hence, the Fed is on hold and is going to be on hold, frankly, indefinitely. I think that this has contributed to the uncertainty. I'm comfortable with the notion that the market is currently pricing in no rate cuts for this year. And just starting earlier last week, we started to see a non-zero probability of a rate hike being priced in for April of next year. I think there's more than 50-50 odds at this stage. Again, I don't think it comes to fruition, but that's going to be a key part of the conversation going forward as a market. So the Fed's forecasts, what we see is the Fed optimistic on GDP. Now, a lot of that is going to be business investment. A lot of that is going to continue to be the AI build out. The wild card is we could easily find ourselves in a scenario where real GDP is above 2%, but real personal spending continues to moderate. And that creates a problem for the Fed because with record low consumer confidence, we've seen a reluctance for the bottom quartile to continue spending as they run up against the reality of higher prices. And again, that leaves the Fed in a difficult situation. One that I do think will ultimately resolve in lower rates and the Fed moving forward with normalization. Now, there's a narrative in the market that every recession in the U.S., with the exception of what we saw in the pandemic, has been associated with a spike in energy prices. And I'll argue that the transfer through to a slowdown in the U.S. is truly different this time. We are energy independent in a way that we haven't been in the past. We still have the overhang of gas prices that will undermine consumption, but as a theme, what we have seen is that the oil shock has really yet to translate through to any material slowdown from the U.S. consumer. I do expect that's a risk, and as we have learned from this uncertainty, the commodities market is unwilling to fully price in the upside for oil prices as a result of the shortage, because what's going on is the energy sector simply going through inventories in the hope that the strait is reopened and things resolve at some point. If we've learned anything from this administration, we've learned that uncertainty is one of the key defining characteristics. And frankly, it's one that I expect will continue forward. So in a scenario in which one is worried about the consumer, it's difficult to disentangle that from the state of the labor market. And I think that the labor market is in a very interesting place at the moment. Over the course of the last 3 or 4 years, what we are seeing is solid headline payrolls reports being reversed out via revisions, whether that was the benchmark revisions, whether it's the running 2-month revisions. At the end of the day, the headline payrolls numbers aren't really telling the full story. And the Fed has acknowledged as much. And the Fed has said what we need to do is we need to focus on the unemployment rate itself. The unemployment rate is very low historically. We're at 4.3%. Now, last month, it did increase on an unrounded basis, but within the 4.3 band, it's difficult to argue that there's anything going on except solid footing for the employment market. Here's why I'm worried. I'm worried because this has occurred at a point in which wages are moderating and the labor force participation rate is declining. A lower labor force participation rate should, in theory, be associated with hotter, not cooler wages. And so the fact that wages are continuing to moderate suggests that there is some credence to the AI concern. There is some credence to the notion that we have seen a material slowing in forward employment expectations. And when we translate that through to the state of the consumer, here's why it matters. A consumer who is not confident that they're going to be employed in a year or 6 months, or if they lose their job, they can't get another job, isn't going to drive consumption, especially when faced with higher nominal prices, higher gasoline prices. It's a very realistic risk that we start to see real consumption start to move lower, even if it's masked by an expanding economy overall. I mentioned earlier that we're at near or record low consumer confidence. We're at levels in which people are concerned about the labor market in a year that have typically only occurred when we're in a recession and when we've already seen a significant spike in the unemployment rate. So as an underlying concern for the consumer, people are nervous out there. People are worried. And we don't see that necessarily in the day-to-day because the equity market valuations continue to prop up the wealth effect, which in effect, has been easing financial conditions and has afforded the Fed the opportunity to remain steady state in terms of monetary policy, and expect it will be the case going forward. Just a few other statistics here. The number of layoffs that we heard announced in 2025, we were at 1.2 million. Again, historically, levels only seen during a recession. And so we're left to ask the question, equity valuations are at record highs. The consumer seems to be in a good situation. When does this all break? What is the inflection point that really gets people to reevaluate their forward growth estimates? And I'll argue that it is more a passage of time and the introduction of the uncertainties associated with the war in Iran that will flow through eventually to the oil market, reprice us higher, further undermine valuations and consumer confidence. And that's the risk that we have as a result of the war in Iran. Also, it's going to translate further and further to geopolitics. Well, we have uncertainties. Trump is meeting in China on Thursday. We don't expect anything dramatic to come out of it, but there's still the unknowns about Taiwan. There's still the unknowns about Cuba. There's still a lot of uncertainties on the geopolitical front that we need to be cognizant of. In keeping with the theme of the labor market, we have declining confidence in terms of the quits rate. So we're back to the pre-pandemic levels, which means that people just don't have the confidence in forward expectations. I mentioned wages. Wages also back to levels that were in place in 2019 and 2020. So the consumer might not be in the same position that we believe that it is to chase prices higher. When we talk about wages, who is the underperforming sector? Those frontline service sector workers that were in such hot demand during the pandemic, they saw a run up in wages, but they're also underperforming. And this matters because we're already seeing evidence that the bottom two quartiles are struggling. We see it in record high subprime auto loan delinquencies. We see it in credit card utilization. There are signs that the underlying state of the consumer is under pressure. So let's talk about the inflation complex. Inflation complex, very topical, very important for driving the Fed. The biggest contribution to core inflation in the U.S. over the course of the last 2 years has been OER and rent and shelter costs, and that is on a trajectory lower. As that creates a pillar to keep core inflation from materially accelerating, then the question is, will the Fed be willing to, at some point, look through the one-off price adjustments associated with higher diesel costs feeding into higher food costs, feeding into higher gasoline prices? That is the uncertainty, but I do expect that it ultimately resolves in the Fed looking at inflation the way that they have tended to in the past. For more context for the inflation structure, we have seen pass-through of tariffs in goods inflation. We have seen core services remain moderate, certainly versus where we were 2022 to 2023. And all this begs the biggest question is, do we see another spike in super core inflation? There's a lot of seasonality to inflation, so it's not surprising to me that we've started this year with the assumption or the expectation that inflation is taking off. But what we saw in March's data was that super core moderated back to levels that are more typical with the Fed's objective. Now, super core inflation is defined by the Fed as core services excluding OER and rent, so takes out shelter costs. Why is it important? Super core inflation has the highest correlation with nominal wages. So in the event that the Fed was truly worried about a wage inflation spiral, this would be where we'd look for evidence of it. And frankly, the verdict is still out. It is unclear if this is going to reaccelerate over the course of the year, hence the fact that we expect that the Fed will take a stable approach on the monetary policy front. Survey-based measures of inflation expectations are also essential in the way that the Fed views what their objective of anchoring forward inflation expectations. And what we see, we're elevated, trending a bit higher than certainly I would like to see, certainly than the Fed would like to see. So as a backdrop for the macro, I think that the labor market combined with some of the forward inflation expectations on the inflation side will keep us balanced, will keep the Fed balanced. So now let's talk a little bit about some of the transitions at the Fed, as well as some of the supply and demand dynamics in the Treasury market, which tend to drive a lot of the conversation when people talk about who's going to buy all the debt. Why are 10-year yields at 4.40 instead of 6.40 given the deficit concerns? So the first thing I'll say is Warsh is coming in. He'll be chair at the FOMC. He's got a difficult job ahead of him. Regional Fed presidents, already 3 of them already dissented to take out some of the language that biases the FOMC statement a bit dovishly. What does that mean? I think that that was nothing more than a shot over the bow to Warsh effectively saying, when you come in, we're not going to immediately start cutting rates regardless of what Trump wants you to do. And frankly, I think that Warsh is a sophisticated enough monetary policymaker and market thinker that he knows that that was never going to be the case. He can't cut rates unless there's the justification within the economic data, even though he's going to try to make the case that if you shrink the Fed's balance sheet, you can justify lower rates or lower terminal or neutral assumption. He might be able to make that case. He might be able to make some of the other changes that he's envisioned, one of which is reducing the Fed's forward guidance, which frankly, I think is probably not a bad idea, if for no other reason than the Fed has so many competing voices that it often leads to a bit of confusion on the part of market participants. So, not to be too glib about it, we actually don't think that the incoming Fed chair will materially change the market's perception of what the Fed can and can't do. It will be data dependent. The fact that Powell is still going to be in the room, he's decided to hold on to his board seat, frankly, to make sure that the DOJ probe eventually and convincingly goes away, which I certainly respect that. So he'll be in the room. We have enough doves and enough hawks on the committee that combined, I think indecision is the clear path forward. So let's talk about the supply and demand dynamic. Treasuries occupy a unique space in the global financial system because the dollar is the reserve currency or one of the key reserve currencies. The dollar status has certainly taken a hit over the course of the last 12 months since the trade war began. Part of what I do is I make the rounds. I talk to major central banks, major reserve managers, and the conversations have all been the same. Our economies, by definition, generate enough dollars that we need to put them somewhere. There's not a deep investable market like the U.S. Treasury market elsewhere. However, we are going to slowly diversify our holdings incrementally away from treasuries and incrementally away from the dollar. Now, the more interesting aspect of that is we see people going away from treasuries and into mortgages or other dollar assets, away from treasuries into SSAs or other fixed income relatively deep dollar markets. So it's not as though there haven't been ramifications from the trade war. They just haven't been as dramatic as to be worth 75 or 100 basis points in 10 or 30-year rates. And I expect that the bulk of that transition has already occurred and people are now settling into the new norm where, frankly, I'm happy to see that what's driving U.S. rates are the fundamentals of forward growth and inflation expectations, which frankly set the outright level for 10 and 30-year rates with a little bit of term premium. And the term premium story makes sense in light of the fact that we do need to borrow a lot of money. We do have a deficit that will require plenty of Treasury auctions, although Bessent has made it very clear that the focus of Treasury Department's borrowing for the foreseeable future will be in the bill market. So I'm less worried about another 100 basis points higher and longer dated rates. And I think that the big story that's going to play out over this year is that patience will create and reinforce the uncertainty, and we will see a fair amount of volatility within the range and a fair amount of dueling narratives for monetary policy expectations and market expectations going forward. Again, as I said at the onset, I do think the path for rates will be lower, not higher at the end of the day, but there will be a lot of uncertainty and a lot of significant unknowns between now and then.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries. For BMO disclosures, please visit bmocm.com/podcast/disclaimer.